Hi, my name is George Dagnino. I would like to show you four charts, very simple charts, but they show something very unique, very different from what we have experienced in the last 50 years. I'll let you decide if they are good news or bad news. My background has been in managing billions of dollars of interest rates and currency derivatives, besides writing the Peter Dac portfolio strategy and management. This is the first chart, and is a chart of the growth in bank deposits, which has been growing at roughly 3, 4, 5%. This is what happened to bank deposits since 2021. Right now, the growth in bank deposit is negative, meaning that deposits at the commercial banks are contracting. This has never been seen since, at least since 1975. What does it mean? It means that banks are not printing money. They're the only ones that can print money. And they deposit are declining because they are not lending money. So there are no people redepositing in the banks, and therefore this is what is causing banks to decline. So this is a very, very different performance in at least again in the last 50 years. This is not good news. Why are the banks not lending money and why deposits are contracting? This chart gives the reason why deposits are contracting. This is the net percentage of banks tightening lending standards. What it means is that when the blue line moves above this line, the majority of banks are tightening lending standards. So they've been tightening lending standards here. Here they're increasing. Here they've been increasing. Why is this important? Because when they tighten lending standards, what you see is a gray line, a vertical gray line, which is a recession. And this one was a serious one. They're mostly serious. Now, here, all these lines, you can read it here, they are tightening lending standards across the board, from autos, real estate, small business, large business, credit cards. Banks are seeing something that probably we do not see yet. But what this sharp rise in the tightening of lending standards definitely is not good news, because this is where major bear market start. This chart shows the growth of the money supply M2. The property of this gauge is that when the money supply goes, like in this period here in the 80s and 90s, grows between 3 and 6%, like Milton Friedman said, inflation is fairly low, around 2%. But when the money supply grows above 7, 8%, like here or like here, you see, or like in the last couple of years, you see inflation going up. But what is ominous about the current trend of the money supply is that the growth of the money supply is declining and now is shrinking. Liquidity is shrinking out there. So it's something that we have never seen, at least since the 60s. So this is trends that are in credit and in liquidity that we have not seen in the last 60 years. And this, quite frankly, is very, very unique. This is the graph of the yield curve, which is the 2-year minus 10 years treasury yields. This is the yield curve steepening, flattening, and inverts. Steepening, flattening, inverts when it goes below zero. Steepening, flattening, negative. Steepening, flattening, inverting. Steepening now is inverted, a new record lows. The last I saw was 86 basis points, the difference between the 2 and the 10. This is very unique levels. And again, what is important things of these charts is that all these credit measures have reached unique times not seen in the last 60 years. Now, why is also important to look at the yield curve? Because after the yield curve starts steepening and reaches zero, which means it's flat, it takes months for the recession to end. It takes months from here for the recession to end. It takes months from here to the recession to end. So even if the yield curve now starts steepening, assuming that it starts steepening, it will take months to get to being flat, and then from that point on, it will take months for whatever recession we are having to end. So this chart is also very worrisome, I think. I don't want to sound like I'm a pessimist or I see bad times ahead. However, it is a fact what these four charts are showing that credit conditions are historically tight. We have never seen anything like it in the last 60 years. So the purpose of this video is to make you aware that we are living through very, very unique times. Now, Jamie Dimon on CNBC said, brace yourself for an economic hurricane. So my point is, what are the banks tightening credit, all that, and Jamie Dimon saying that we do not? Do we have a credit bubble in everything? Is this the time we have to pay the piper for the horrendous policies followed since the pandemic? I don't know, but we are living what the charts, the four charts that I showed you are saying, we are living in very, very unique times. I publish the Peter Duck Portfolio Strategy and Management every week on every Sunday. And of course, you can look at what I say and how my approach to investing. You can get a free subscription, www.peterduck.com. This is a book that McGraw-Hill Education paid me to write on how business cycles impact the financial markets. That's really my specialty. I also wrote two other books, Easy Ways to Beat the Market with ETFs. This is a book testing various ideas on how to use moving averages. This is Investing Wisely. It is easier than you think. I also show how to select stocks based on using relative strength analysis. And also you can follow me on Twitter at George Dagnino, where I publish regularly, update my charts and my graphs and my ideas. Thank you for visiting and following my videos and my ideas. And I really hope to see you really, really soon. So long. Take care of yourself.